All right, so we just got done filming awesome podcast with Russell Brazil. James, what do you think? How'd it go?
I think it was a great episode. People are going to listen to this one. They're going to challenge some of their assumptions with how to move forward with real estate investing, what strategies are best. But with the market that Russell's in, he's really defined and refined his strategy for upscaling, upgrading his real estate properties to go from some of the modest properties that he started off with to $1 million row homes in DC. So I think our listeners are really going to take away a lot from this episode.
Exactly. And if rent control and some other of those, key landlord issues mean anything to you, you definitely want to listen to the end because we get into some of that really cool stuff on his lobbying side. So make sure to check out the full episode. How's it going, everybody? And welcome back to the Real FI podcast. I'm your host, Patrick McGrath, with my co-host, James Rippion, in the hat today. How's it going, James?
Wearing the hat today. Thought it'd cover up the hair. Too many compliments coming from Patrick. But feeling good today. I think we're going to have a fantastic episode. We got a real estate OG in the house today, Russell Brazil. If you don't know Russell, he is all over Bigger Pockets, up and down, commenting, posting, left and right. And he's been on guests on many other podcasts. He has his own podcast that he also hosts. And he is a wealth of knowledge, to say the least. So, Russell, why don't you introduce yourself, my friend, and tell us a little bit about what you got going on in your life?
Sure. So my name is Russell Brazil, and as James said, I'm a big contributor to the Bigger Pockets website. My life touches on many aspects of real estate. So I'm a real estate sales agent. I work primarily with other investors. I'm an investor myself. I bought my first rental property 14 years ago now. I flipped my first property just over 20 years ago now. I'm involved in lobbying for the real estate industry. I'm involved in leadership for realtor associations. And I just do a little bit of everything within the real estate world.
Love it. Love it. Love it. So 14 years of really investing in real estate. So let's talk about what that portfolio looks like, just to give the audience, the broad scope of, where you're at today.
Yeah, so my portfolio continues to change and evolve. My portfolio at any given moment can be between 10 and 20 units as I either buy a new property or sell off an old one. So most of my properties are in the DC area. I've got a few in North Carolina, but primarily they are in the DC area, in the areas of Montgomery County and DC, Washington, DC itself. I've previously had stuff in Prince George's County and Frederick counties as well, but I continually use 1031 exchanges on my own portfolio to keep trading up cheaper properties to more and more expensive properties.
That's a really great strategy.
Let's talk about some of those properties. Like what describe those earlier properties that you started to get into, and talk about what your portfolio currently comprises of with the real estate that you own.
So I think this is a really cool scenario that I've done, and I've done this actually 3 separate times. So if we go back to 2009, 10, and 11, I had a couple of single families, but a lot of really, really cheap condos. So 3 of the cheap condos I had were in an area called Frederick, Maryland. And I basically bought all of these condos for roughly $100,000, between $100,000 and $110,000 each. So with a down payment and a closing cost, that would take me about 25 grand to get into each property. Now let's fast forward to say 2015. My values have gone up in those properties. So I start selling off these condos that I bought for around 100,000. Now I'm selling them for around 200,000, anywhere between 180 and 210 on each of the 3 exits there. And I 1031 exchange those into single family homes in a more expensive area of Montgomery County. So now I'm putting about 100, between my buildup in equity there, that's the natural appreciation, as well as my original down payment, some debt pay down. I'm coming out of those properties with 125 to 150,000 in cash to use. So I put those down payments on $400,000 properties around middle of the decade, 2015-ish. Now we fast forward to around 2020. The equities built up in those properties. Those $400,000 properties I had now are worth 550, 600. So I start selling off those. and start 1031 exchanging those as well into row houses in DC worth about 800,000. Now we're a few years into that process. The equity's starting to build up again there. So now, now I buy these properties for 800,000 and I'm putting $250,000 down, but now they're rising in value, right? So today, maybe I have $500,000 in equity in each of these properties that was all created from one $25,000 original investment. And so it's a strategy I've executed multiple times. And as these go up in value, right, in 3 or 4 years, when I start getting bored with them, I'll probably do the same thing. I'll sell those and I'll start, trading up from a $1 million property there, 1.1 million, to maybe a $2 million type of 4-unit in our market. So I'll just keep trading these up, keep creating more equity there. And yeah, I mean, really, really simple process. Not like I planned this. I did it once and I was like, oh man, this is great. Did it again, keep doing it. And it's worked out really, really well.
Bam. And you're looking, 13 years later, Russell's become an overnight success, and it'll happen really quickly. Just kidding. No, you just have to have a little bit of patience, and stick with it. If there's one thing about real estate investing, you don't have to reinvent the wheel here. And you just have to be buying, being patient, holding, paying down your debt. And as Russell was saying, 1031ing into the next property to avoid any adverse tax consequences. So it sounds like you've really put together a strong portfolio that you can recycle the equity in over and over and have a set path to move forward to the next deal.
Yeah, and obviously the key really is the 1031 exchange, because when you're selling the property without the exchange, not only are you paying taxes on that appreciation, you're paying the depreciation recapture as well, right? So if you're not using a 1031 exchange, you're losing so much of your value when you sell. And the ability to defer all of those taxes and keep that, capital to keep growing is really instrumental, I believe, in, creating a large sums of wealth.
Yes. And I think one of the things that I love, not only the fact that you've been utilizing the 1031 exchange and exchanging up and showing that progression, was that it also sounds like you started off with one particular thing in mind, with one way of investing it in mind, and it's evolved. Instead of really changed, it's evolved over the lifespan of your investing career so far. And that's kind of what I like to touch on, because as an investor myself who's been doing this for let's just say a little more than 5 years, the Patrick that started investing and when I was buying and thinking about how long I was going to hold these properties for and everything has kind of changed 5 years later. I'm looking for different things. I'm thinking about, time horizons more, and I'm thinking about my return on equity, which sounds like that is a metric that you look at as well.
Yeah, so the return on equity is definitely something I consider. It's definitely, I wouldn't say it's my driving, motivation, but as I start to see, let's go back and look at some of these condos, right? I've got 25 grand into them. They're cash flowing small amounts of money, $300-400 a month. And that's fine when I was into them for 25 grand. But as that equity starts growing to 100, 125, 150 grand, I'm like, man, I could keep holding these, making $300-400 a month. They're still gonna go up in value. Or man, what can I do with this equity that's going to, bring my leverage back into a more highly leveraged position, right? Because when $100,000 condo goes up to $200,000, now I've got more than 50% equity in it. I might as well trade up to get the best asset that I can. And so that's what I did. I started trading them up, and then trading them up to better assets, right? Single family homes in general in most of the country are a better investment than a condo. And in our market, row houses are the highest appreciating asset. So as my equity started to build up in single family homes, now I can start buying the really expensive row house, which is going to appreciate, at a rate higher than the single families. And so, it's not that I don't like the asset classes that I'm abandoning. There's just always going to be something better. But I can't jump from, you got to start somewhere. If I only get 25 grand to invest, I got to buy almost the cheapest asset I can find and make it work. But as the equity starts building up, what can I do that's going to make better sense with that equity? How can I deploy it to get an ultimate, better return? And I'm finding every 5 or 6 years is how often I'm selling my properties. That's when the equity buildup in our area at least starts getting to a point where I'm like, wow, it's appreciated. What can I do that's better with this equity?
But I think it's interesting with your strategy is you're moving from one to one. You're doing a 1-for-1 trade as far as unit count goes. It sounds like for the most part, you're not trying to accumulate as many doors as possible, which I think some people have the tendency to want to do for one reason or another. Either they're trying to get cash flow or they think it sounds great. But your strategy seems a little bit different in that regard. Why don't you explain to our listeners why you've effectively chose to upgrade in this manner?
Yeah, great question. So many people want to acquire as many doors as they can. I don't like dealing with tenants all that much. And even if I have property managers managing it, they can still be a headache. So instead of having 100 low quality doors, I'd rather have 10 or 15 really, really high quality doors. And so the higher quality of the property is often going to be more expensive. But, my tenant base consists of people that are lawyers and doctors, and I even have another real estate broker that lives in one of them. So by having high quality assets with high quality tenants, you almost never see me in court filing for evictions. You did when I had cheaper assets, but when I have $1 million asset that's one door, the kind of tenant that lives there, they pay their bills. So it's less headache, it's less management intensive. I do this random talk when I talk at RIAs about how to manage a high quality portfolio in under 15 minutes a month. That's how long it takes me to basically collect my rent, pay the bills, look into any minor repair requests that happen. And no headache. But very straightforward. I am sacrificing a lot of cash flow, but I am making that up by having a higher quality asset. I'm generally making up way more than the cash flow in the amounts that my properties appreciate.
Well, it's certainly all about trade-offs, and some assets are going to give you the cash flow side of things, and some, as you've kind of keyed on here, are going to give you a little bit more appreciation. At the same time, a little bit less headache. So for the properties that you are buying and trading up to, are they newer builds or are they older classic construction? Like what type of property physically and attributes are you looking at when you're purchasing a new asset?
Yeah, so when I was buying condos, I was really looking at things that were 1980 or newer. The condos that were older than that typically have problems with their condo fees just being too high to make sense. Once I started trading up to single families, I really prefer properties that are built after World War II. After World War II properties generally have more modern plumbing, more modern electric. I'm not dealing with all the problems that come up with old houses. But as I trade then those single families up to historical row houses in the city, suddenly I'm going back to properties that are built between 1850 and 1920. And they do have more problems. You don't know what's behind those walls, but we've got lead pipes in the city, we've got bad electric. But by the time I'm trading up to those, the reason I'm trading up to those is because a historical row house in the district is the fastest appreciating asset we have in my market. So by the time I'm trading up to those, I'm okay with taking on the risk of those older properties because now I've got substantially more wealth to deploy and take care of the problems that come along with those. But when I was in those medium term, assets, sort of the middle of the road, the single families, I really did like the post World War II ones because they modern electric, modern plumbing, just very little problems, except once I had a sewer line collapse, but that happens.
Yeah, there is there was a lot of those post World War II tract communities built all over Maryland, Virginia area, and that's kind of what we first got into as well with the single families. A lot of 3-1s, 4 1.5s out there. Now with investing on down in DC, in our lovely nation's capital, in these older properties, you're looking at a 1.2 million dollar property. Let's talk about what something like that rents for. Are these, are you splitting them up into multiple units? Doesn't sound like it. It sounds like you want to keep it all rent it to one person. Like, what does the rent look like? Break some of that down for
Yeah,
us.
great question. So one of my favorite strategies is to target certain neighborhoods where the Section 8 rents are high. I've got two properties that are Section 8 right now in the district where this works well. We take a 3-bedroom row house, where it's a typical 3 bedrooms upstairs. And if we have the proper ceiling height in the basement where we can get 5 bedrooms into it, a neighborhood, some of the neighborhoods that we can do this in where the Section 8 numbers work are Kingman Park in Tacoma. I know people listening from probably all over the country, but this just allows you to, Google and learn about these neighborhoods. So I can go into Kingman Park and buy an $800,000 property, throw 2 more bedrooms in the basement. And what the market rate rent on this would look like is about $4,000. So most properties in DC rent for about 0.5% of the property's value. So an $800,000 property rents for $4,000. But in this neighborhood, the Section 8 rent, once we get the 5 bedrooms in there, is right around $5,500 a month. And so we get a $1,500 bump in Section 8 in that neighborhood. These large Section 8 bumps are almost always as we go from the 4 to the 5 bedroom, because they become a rarer asset, and so the Section 8 rents are really dramatically high. But that's not all of my portfolio. I've got a couple properties like that. Additionally, I've got a row house in Shaw. This is one of my favorite properties, and it is just a normal 3-bedroom, 2.5 bath row house, and that one rents for $4,800. And I think we paid about $850 for that maybe 3 years ago. And as I'm buying these, right, remember I'm 1031ing, so I'm usually putting more than 20 or 25% down. A lot of times it's getting to 30, 35%, depending on what the equity is. So that creates more breathing room for us on the cash flow, right? Because an $850 property, that's probably got a mortgage payment. I think that mortgage payment's like over $4,000 on it.
Okay. So between, you've got $4,000 a month principal, interest, taxes, insurance, all of that, maybe you're getting 5,500, in the best case scenario. So you might be cash flowing, $300 to $500 a month on one of these giant properties. Yep. But you also have all of that built-in equity because you're 1031 exchanging up, so you're not necessarily losing any of that money. It's still sitting there in the asset. You're still collecting money. People are still paying down the debt, and the appreciation over time, like you said,
what we're finding is row houses in the city, depending on the neighborhood, are appreciating about $50,000 per year, right? So if I hold a property for 5 years, it's going to go up $200,000 and $250,000 in value in the city. In the suburbs, still we get good appreciation there. The percentage is probably about the same because the property is about half the value and they're appreciating about $25,000 a year. But we're making up so much money in appreciation. I'm someone who doesn't need cash flow. I make a very comfortable living selling real estate. So eking out an extra $500 or $1,000 a month on the rental isn't moving a needle for me.
1,000%.
But 50 grand a year, that is moving the needle for me.
So what would you say to that new investor though? Because I know the first thought that's coming to their mind is, oh my God, the 1% rule. How's this thing going to work? What would you say to that investor who's overly concerned about making something cash flow? And you've given some of your perspective of your personal life situation, maybe allows for you to make this work. But, for that investor that is incredulous to an investment like this, what would you tell that person?
Yeah, my philosophy in investing boils down to, I really believe in buying high quality assets in high quality locations. And so I think we just got to look at what our budget is, and our budget may be meager, right? A lot of the properties I started out buying were $100,000. It took 14 years to where I'm dealing with $1 million properties. So I say buy the best asset you can, given your budget, even if it's meager. And I'm just a firm believer in getting rich slow. Year after year, hopefully, your property is going to go up in value. That's not the case in every market, though, right? We look at Baltimore. We're not far away from Baltimore, and in 10 years, some of those neighborhoods have not gone up in value. So I do think you want to try to buy in an appreciating area, and just buy the best asset that you can, even if it's not expensive. Condos by no means are a superb investment, but they got me to where I needed to be, right? They got me in the game. They, a couple $100 a month 14 years ago did mean a lot to me, because it allowed me to save quicker and quicker for the next property. So, I'm just a firm believer, the longer you're in the real estate market, the better you're going to do. Time in the market beats timing in the market. So just get the best asset you can, given your price range.
I think that's really, really solid advice. And what are James and our hats, basically are saying is decide, commit, take action, get into the best asset that you can afford. And it's going to change along the way. You're gonna trade up. You're gonna have some more money down the road, get a better job over time, start saving up more to buy better assets, learn from your mistakes. It's growing. I love what you said, get rich slow. I know all of us going into real estate, if you're doing the buy and hold long-term wealth method, hey, you're thinking about holding this rental property for 30 years. It might not necessarily be that property, but just being in the game for those 30 years, it's that get rich slow. It's going to take a long, long time. I appreciate that so much, because on this day and age, when we've got YouTube and Instagram and TikTok and everybody talking about how much money they're making every month, everybody wants that instant gratification. And it's like, you're a prime example of, if you just grind it out, just keep trading up every few years, keep investing, down the road, it's going to end up paying off big.
And don't be afraid to make mistakes too, right? Like, I've had to evict God knows how many tenants. I've had tenants destroy properties. And it seems like the worst thing in the world is it's happening. And it's really nothing you can't recover from. Real estate's very, very forgiving. Once you get the tenant out, you still have the asset, right? So I've made tons of mistakes in my time as a landlord, but they're all, we over dramatize them when they happen, and you look back and they make funny little stories.
Well, a lot of the time that frustration comes from not knowing what the hell you're doing the first time it comes around. And, hopefully everybody who's getting into self-managing properties, they're learning from those experiences, refining their systems, hopefully not letting that stuff happen twice. But it's all part of the learning curve with real estate. Real estate is a great industry to get into and learn by doing. Of course, you want to do research, you want to talk to people who have been there and be prudent with the moves you're making. But it's a great opportunity for somebody to get into the business, get started. And it's honestly not that hard to manage your own stuff. Anybody can do it. You can do it from afar as well. We've talked to a lot of people that do it that way. So it's totally manageable. Russell, I want to talk to you a little bit about your sales experience, because I know that you work with a lot of investors and help them find deals. Why don't you tell us a little bit about your role as a real estate agent and what you do for investors in the DC metro area?
Yeah, so I work primarily with investors. It's not to say that all my clients are, but about 80% of them. And what we try to do is we try to figure out what is the right type of asset for this person? What is the strategy they're trying to execute? And as you work with investors, what we find is there's hundreds of different strategies, and they're not all applicable to all individuals. So, right. So I've got one client, he buys a brand new luxury condo every single year in cash, which most people would think is a terrible investment. But it works for him. What he's trying to do is he's trying to preserve capital. He's from another country that's not as stable, right? And he comes here and he's higher income. And so for him, capital preservation is the really important thing with the highest quality tenants. So he buys something that none of my other clients do. Then I've got other clients that are rehabbing. We've got other people that want high cash flow, they buy in Baltimore. We get people that want low risk strategies that buy in DC. So many different strategies that we help different people execute. And really, I think one of the biggest things we do, so we do about 40 to 50 sales a year, so right around one per week. And what we try to do is really just narrow in on what's going to work for the individual and try to help them make their own decisions on what's going to work for them. Because we actually like to do a lot of the Socratic method, right? Ask people questions, get them to answer questions, and help them get to what they already feel is intuitively right for them. So some people want high risk stuff, they want cash flow. Other people want low risk stuff, and everything in between. But we try to really point to people towards what their comfort level is. And what we find is when someone's got a good comfort level with what they're buying, they become repeat clients for us. So about 3 out of 4 of our clients repeat in less than a year and a half. And so we love working with investors for that reason, because they're just a constant source of deals for us going on with the same individuals instead of having to constantly generate new business.
I hear that all the time. Keeping the customer that you have is way more valuable than going out to the market and finding a new customer. And this applies to pretty much any business, I think, for the most part. It's a pretty universal rule for business. What do you think, Patrick?
I was just in a mastermind last week, and I was presenting to a ton of agents. I am not an agent as an investor. And I was just talking about the importance of building your investor network, because you're going to be selling or providing service for that same client over and over and over again. And they're going to be an advocate for you when those other people that can bring into your network, ask you as the investor who you recommend, or seeing you, closing deals with this person. So it's a continued source for agents out there. And during a slow time, when interest rates are high and, your average person isn't going out and buying, investors typically are still buying real estate.
Yeah, we've definitely noticed the shift. So like I said, normally 80% of my clients are investors. During the big sort of market run up here the past couple of years, maybe the investors eased off a little bit, but the last 6 months, they are out of the woodwork. And I bet 100% of the people I'm working with currently are investors. And James, I think it was funny because you mentioned it's cheaper to keep an existing client than generate a new one. I always think of that line from The Office when Ryan says to Michael, it's 10 times more expensive to acquire a new client than it is just to retain a client you already have. And it really is true.
1000%. So Russell, I confided in you a couple years ago, right before I decided to make the move down to North Carolina. And basically, I was leaving my old profession, looking to become a real estate agent for the hopes of building a real estate business, doing some of the things that you're doing, things that are similar in nature. What would you say to somebody, though, that comes up to you off the streets? I'm sure you get this a lot. Should they become a real estate agent? Should the regular investor who's looking to get into investing go out and get a license? Now, you're an investor, you're an agent as well. What are your thoughts on blending the spheres of that right there?
Great question. So I think you need to treat being a real estate agent like you would any other business, right? And so most businesses don't actually turn a profit till their 3rd year in business. And 90% of small businesses fail. That's right in line with how many real estate agents fail out of the business, which is 87%. And both businesses and agents fail for the same reason. It's because they don't have a proper or they don't have a proper access to capital, right? They don't understand that when they come into this business, what they are really doing is running a small business. There's overhead that has to be paid. There's software, there's MLS subscriptions. You need money to market. You need money to brand yourself. So if someone comes into this business, I think that they have to treat it like a business. They have to have capital to run the business, even if there's no money coming in. And if they can treat it like a business and not expect to make a profit in the first year or two, then their chances of success go through the roof. When I went into real estate sales full time, I had like 60 or 70, maybe 60 grand a year in cash flow coming in from my rental properties. So that gave me money to pay my bills. So I knew that I could go a long time without actually making a commission and, build my business. So if someone has a rental portfolio, I think it could be a good option for them, because if they have money coming in, that's great. If they don't have a rental portfolio, you really get to have a lot of money saved up, put in the bank, because you don't know when you're going to make that first check. And you know what? Even when you make that first check, might be 6 months till the next one, because it's going to take you time to build a book of business and learn how to generate, the same amount of business month in and month out. I know people in the business 30 years that don't know how to do that. Me, like I said earlier, I close pretty much a deal almost every single week, and we just have a very good system set up to do that. But it took not a long time, but it took 4, 5, 6 years to get this consistent.
Yeah,
Exactly.
I can attest to that. It's no easy walk in the park to set up a real estate business. I probably thought it was going to be easier than it was, honestly. But it's, you eat what you kill, man, and it's no business is easy to get off the ground. And like you said, you're destined by the law of averages to, maybe not have a really easy time at it for the first couple of years. So really, if anyone's deciding to get into it, take it seriously and treat it like a business, and have, as Russell said, that capital to get going.
And if someone is going to be new in the business, I do think not a bad idea is to join a team. You're going to make less money than you would on your own, but you're going to make money substantially quicker, right? So teams are going to have more leads. You may get a very small cut of what you're closing, but they're going to get you making money, at least to pay your bills quicker. And you get to learn from people that know what they're doing. It's actually, there's a lot of complexities to the business that people think it's, like you said, they think it's going to be easier than it is. There's a lot to learn to it.
Mm-hmm.
I really like that. So what tips would you have for an investor listening to this podcast to work with an agent? Maybe, they don't have the perfect agent yet to work with for them finding, their investment property. Like what would some tips be that you have for the listeners out there?
You got to interview people and see if they're a good match. There's like some absurd stats, something like 75% of people use the first agent that they've ever met and don't actually interview someone else, right? And there's over 2 million licensed agents. Just by having a license doesn't make them good at what they do. So you got to interview people to make sure they know what they're doing and make sure it's a good fit. If they want to be an investor, I really suggest working with an agent that invests themselves, right? It is completely different to talk about how to evict a tenant versus when I can relate to someone, exactly how to do it. And not even that, like I can tell you the difference in the nuances between evicting a tenant in Montgomery County versus Frederick County versus DC versus PG County.
I don't want any of that.
Yeah, and each place is they all have their little nuances, and so you want someone that if they're investing themselves, they probably understand all these little nuances in the market, and that's where the value comes in. The value isn't in writing a number on a contract to make an offer. The value is in the knowledge base and understanding the nuances. Anyone can fill out a blank form and put numbers in there. You really want to work with someone who knows what they're doing, understands these nuances. So you got to be willing to interview people. And this can interfere with some things, right? I think I read something like the average person knows like 5 real estate agents. So your cousin Bob may be an agent, but may have no expertise in what you're trying to do. So you got to be able to forego some of these other relationships to find the person that's going to work well with you.
I think that's really important too. And in addition to what you're saying, and it goes off of what you're saying, being able to find that agent that can kind of think creatively and a couple steps ahead, especially when you're dealing with investments and you're dealing with tenants. When it relates to evictions, for example, maybe you could do cash for keys. Maybe you could come up with some other creative arrangement to avoid the eviction process, align goals, and get people to be on the same page and make things work out better financially for yourself. So, just going to Joe Schmo real estate agent, they might not have an appreciation of some of those more fine-tuned business experiences in real estate that would help you in the long term. So I agree with that 100%.
Yeah. So we've talked about, your overall rental portfolio. We've talked about your business, since you're in the investing business and the business of real estate. So let's break down some numbers a little bit. You told us about, one real estate transaction a week, anywhere from 10 to 20 different rental properties. Like, first of all, what's that overall look like? Just for the listeners out there, everybody loves numbers. If you want to get into it on, your cash flow goal or your real estate portfolio, and then what is your goal to get up to? Is that an equity net worth? It doesn't. I know it's not cash flow at this point. Does that plan on switching anytime soon? Let's get into
Great
some of
question.
that.
So in a given year, my free cash flow, this is the amount of my cash flow after I've paid my mortgages, not before I've paid any sort of repairs or capital expenditures. My free cash flow tends to be currently between 110,000 and 120,000 a year. Repairs whittle that down. And so in a year, if I don't have any major capital expenditures, I'm usually making about $100,000. Some years better than others, some years worse. We've all been there, right? Three HVACs at 3 different properties go out in a 1 month period, always right in the middle of July, right? So those years worse, but 120,000 free cash flow, which gets whittled down to the 105,000 real cash flow. My goal is to get up to a net worth of between $7 million and $8 million. What I conservatively calculate using the sort of standard 4% rule is something in that range is going to throw off 300,000, 350,000 if if I just have all the money in stocks and I'm taking 4% out a year. That's sort of my goal for where I feel like I'll be really comfortable in retirement. I can still live here in a very expensive metro area of DC, making $350,000 a year in retirement income. I suspect that, so I'm 44 years old. I suspect I will be 50, maybe 52 when I'm hitting that. That all depends too, right? Stock market's down 30% in the last year and a half. So projections don't look as great today as they did a year ago, but we'll see. And I try to stay sort of 50-50 stocks and real estate. As each market goes up and down, that obviously slides out of equilibrium. But 7 to 8 million is sort of my goal, and I actually think I'll continue to work after I hit that. That's just what I consider my financial independent number.
James,
you're muted. There you go.
We keep making a habit of that. What kind of motivated you to have the asset split of roughly 50-50 stocks and real estate? A lot of people we talk to, they either become all in on real estate, or they're starting their own business and they're selling everything to get to that. What made you go and decide about roughly that split?
Yeah, it's just a matter of spreading out my risk. I love real estate. I sell it for a living. I believe in it, and I do get in return that is on average substantially higher than the stock market. But I also believe in the stock market. The stock market, over the course of time continues to return 8% per year. Sometimes that's negative, sometimes it's up 25%, right? But I do ultimately believe in both forms of investing. Real estate does better for me because it's leveraged. If I was leveraged in stocks, I would get a higher return in stocks too. But it's just a matter of spreading out the risk. I've also started, not largely, but started a little bit investing in private businesses. So I have a stake in a title company, for instance. I'm getting ready to invest in a tech startup that's in the real estate realm here pretty soon, just to sort of dabble relatively small amounts of money into some other, higher risk things to see how they go.
What I really like about that is, you know, I'm sure that you feel more comfortable because you have built such a solid foundation um, of, not only cash flow, but of the complete assets that now at this particular point, you feel comfortable and you're like, okay, I can risk this, whatever it is, 10 to 50,000 over here and over here and over here. If they don't pan out, it's not going to be the end of me. But if they do, the risk reward is extremely, extremely high.
Yeah, so we're looking at things that where I might be 50, right? 15 years ago, I would never put 50 grand all into the same thing. I'm be like, man, I could buy multiple properties for that. And if I lose 50 grand today, it's not going to destroy me like it would 15 years ago, right? So, but I very well may get a 10x return, and that's a very aggressive belief, but it could happen. More than I probably won't lose, and the investment probably won't get wiped out completely. It'll probably more than double in value, but has the potential of being huge sums of money. But you deploy a little bit here, a little bit there, and I will say I don't invest in crypto. Even though this sounds like a strategy that could work there, right? You might get a 10x return or might lose it all. I am generally still a low risk investor. I invest in things that are very tangible: real estate, stocks, startup businesses. I don't see the tangibility in crypto that other people do, but.
So when it comes to your real estate portfolio, though, when you hit that 52-year mark, are you looking at your portfolio and saying you want to have that paid off? Is a paid off real estate kind of what you're factoring in? Or are you still going to continue to have leverage and maybe keep 1031ing and trading up those properties?
I always want to have leverage. The returns that are generated in real estate are generated by the leverage. So on average, like my internal rate of return I've achieved here in the DC area, averages about 22% per year. If we were to remove leverage from that, I don't even know what it would drop to. It'd probably drop to less than my stock returns. So I love leverage. I love debt. I know everyone's scared because rates have gone from 2.5%, 3% up to 6%, 7%. When I started investing, I was paying 6%. So these look like normal rates to me, but I still love debt. I love the juice it gives to the overall return.
Well, it's really funny. I had somebody reach out to me the other day because they're the first time home buyer and they're looking at rates and they have the short context of the last 3 years.
Yeah.
With their mortgage history experience, 2%, 3%, and it's up to 6%. And I was asked, is this like an American peak for mortgage rates? I'm like, you gotta be joking. Not even close, man. Maybe 3-4x what we got now. And that was the peak. But
it wasn't that long ago they were where they're at now.
I know. It's people have short memories, very short memories. So, with all this you got going on, you got your private investments, you got your stock portfolio, your real estate. What is motivating you to keep going? What is making Russell get up in the morning, sell all this real estate to investors, do the podcast that you got? What's really motivating you?
Yeah, so I'd say I probably get two. Let me just touch on this because I think the listeners might find this interesting, because we're talking about the rates. When I flipped my first house 20 years ago, I paid 4 points and 15% for the hard money. Somehow we made those numbers work way back then, right? But what motivates me? I think there's sort of two main things that sort of really motivate me. Number one is I really like helping other people. So when I'm working with investors, a lot of times I'm working with people that didn't believe they could achieve home ownership or didn't believe that they could achieve buying a rental property. And a lot of times we're helping people buy their first one, setting them down the path of financial independence. I love that. What other job can you do where you make a lot of money and you help people immensely and they are immensely grateful for what you've done for them? So that's awesome. And then the other part, I think, honestly, it's a little bit about ego. I love being respected in my real estate community. I love people knowing me. I love going out and socializing with other people in real estate. So there is a little bit of an ego effect with me, quite honestly.
And I think
I
that
love
shows a
the
lot of humility that you can, pinpoint that. I mean, everyone likes to socialize, and when you're the source of knowledge for a lot of people, it ultimately feels good. And having that knowledge enables you to give back too. So it's kind of this, self
The
fulfilling
yin and the yang,
thing.
yeah. And by doing this, right? So by helping all of these people, I get to meet other amazing people. Like, so I sit on the board of directors of the National Association of Realtors, 1.6 million members. That's something I wouldn't be able to do if I wasn't helping all these investors that choose financial independence. This I'm leaving on Wednesday to go to a conference where we're going to mastermind with some former congressmen about how to achieve our goals in protecting property rights on the Hill and strengthening fair housing standards, right? So I get to go meet some unbelievable people and work with them on some really cool, important issues. And that's really cool, I think.
I think that sounds extremely interesting. Could you maybe get into a little bit about your involvement with the board? Are you on some sort of like lobby group, or
Yeah, so
how's
the
that
National
working?
Association of Realtors is obviously a very strong lobbying organization, and I do a lot on the lobbying side. So on the local levels, with our local realtor associations, I sit on our public policy committee, and we lobby for laws in Montgomery County, DC, and with the state of Maryland. And then on the state level, I work in what's it called? Issues mobilization, where, so for instance, Prince George's County, a couple weeks ago, introduced legislation on rent control. So on the state level, we met and we created a plan. We're going to put so much money towards fighting that legislation. And then by de facto being sitting on the local board that I'm on, because we're a huge board, I ended up with a seat on the National Association of Realtors board of directors. And so on the National Association, I've worked on different issues. One of the issues I've worked on was racial bias and appraisals, which is a really interesting and a lot of facets to this. But when we're on the boards of these things, we end up working with our elected leaders, trying to get them to pass the right regulations to help, realtors sort of have two pillars. We, as an organization, we have a relatively left-leaning pillar, which is promoting fair housing in an equitable marketplace. And then we have a right-leaning pillar, which is protecting property rights, trying to fight rent control or overburdensome regulations. And because we're a nonpartisan organization with a somewhat left-leaning pillar and a somewhat right-leaning pillar, because of that, we're incredibly powerful and we're an effective lobby because we're not trying to promote the interests of any one of the two parties. We're trying to work with both parties to achieve our goals. And because of that, we get a lot of our goals passed. Every time you see a new first-time homebuyer tax credit, or something like that, we've usually had a hand in making that happen. So get to work with really, really cool people that are really passionate about these subjects. You get to work with, some people that you think are assholes too, quite frankly, right? Because inevitably, as an individual, you end up as a member of one party and have to work with a congressman from another party who may agree with you on property rights, but nothing else in the world.
Yeah. So for someone out there who just listened to all that, and that sounds really interesting. It sounds interesting to me for sure. How would you say someone that is not maybe a realtor or on a board out there, how could they themselves get involved in their local market with some of their local real estate landlord laws? Like, what would be the best way for them to kind of get involved?
So a couple different ways is most areas are going to have a landlord association. Join it, go to the meetings, get involved, testify when there is legislation that gets brought up. People underestimate, like, we just had an important hearing in Annapolis just last week. Anyone can go there and testify. any member of the public. So we not only send realtors to go testify on some of these subjects, but some of my investors went and just testified, and we'll see how things work out. So join your landlord association. If you are a real estate professional in any capacity, title attorney, mortgage lender, home inspector, you can probably join your local realtor association as an affiliate member, and then you can join one of their committees that works on these issues. So on our local public policy committee, we've got all kinds of professionals: mortgage lenders, realtors, title attorneys, guys that work in the 123 junk. They junk out houses. They're a realtor affiliate member. So by joining these, you get really a good into the legislation, and you get to make an impact, and you get to build relationships with your elected leaders. If you start building relationships with your elected leaders through these organizations, guess what? They're going to be more likely to actually listen to your concerns. I have good relationships with most of the Montgomery County Council. I've got good relationships with many of our state legislatures, and they want to listen to me not just because I'm passionate about the subject, but because they see me at all these events and they build a relationship with me year after year after year. So now it's not just like, oh, Joe Schmo we don't know is coming to complain. It's concerned citizen that I've dealt with 5 other issues. He's back again, and he's going to teach me about something maybe we missed. And it's funny because we're gearing up for a rent control fight in Montgomery County right now. So
Well, that's why when you said Montgomery, PG, I was just like that. Those are all of the counties that I strictly stay away
yeah,
from. In DC, I'm like Carroll County. I'm out here.
a little more
And
landlord friendly in Carroll County.
exactly, I choose that. But you're fighting the good fight for everyone out there, and I know I'm trying to do more of the things that you just listed off, to be more involved and to be a face that my local officials, know of and can rely on to tell them the truth about what's going on, and praise them when things are going good or it's a good issue, and be an ear for them when I have something to say. So I love all of that. But with that being said, like, what are some of the obstacles that you're facing right now, not just politically, with all the associations, in your real estate business and in the overall real estate business, right now for the next 12 to 18 months?
Yeah, I mean, I think the biggest obstacle is one that, touch on a little bit, is rates are scaring buyers, right? I'm still buying regardless of the rates, but obviously we got less buyers today than we had when rates were 3%. So that's certainly an obstacle. It's not impacting me terribly, right? So I always find the pendulum will swing for me. Happen to be working with a lot more sellers than buyers right now. But I prefer buyers. So, I'd rather some of these buyers come out of the woodwork and start buying. So rates are scaring off people. That's challenging. Definitely the politics with rent control being introduced in multiple counties, or legislation being introduced, not law yet in any of them, but fighting this rent control battle is going to be stressful here over the next year. I think we are likely to see a very restrictive form of rent control in PG County. Their legislation says 3% raises per year, and it is likely to pass. Actually, the vote on it's tomorrow. In Montgomery County, there's 2 bills introduced. I think one of them will get passed, but it has a very high threshold. It's probably going to be 8% plus CPI that's allowed. So I don't raise my rents 8% a year anyways, but still, we don't want any sort of restriction, but we're probably going to have to learn to live with that.
I think that's extremely unfortunate for a lot of the people involved. I think some people think that's a win. Some people think that's, a loss, but I think that's unfortunate for
we
those
saw in
areas.
Oregon did something similar where they created a law that allowed a high increase plus the CPI. But what happens, right? The law of unintended consequences. As we know, 70% of housing providers are small landlords. Small landlords tend to not raise the rents very much on their tenants. What happened in Oregon once they instituted this rent control?
7% a year, probably.
Yeah, all the landlords started raising them to the max of what the law said that they could, because they became afraid that they would fall too far behind and not be able to catch it up. So a legislation that was meant to create more affordable housing has the opposite effect and raise the cost of housing. And so
And
the same
government
thing
housing
will
too.
happen here.
But that doesn't for so what's insane is it does it for government housing too, because the mom and pop landlords are raising their rents every year. Now the people that have a voucher program or whatever, they're no longer at market rates. So then the government has to raise their rates, and it just creates this.
Yeah, and we've got 100 years of data on rent control, and it's just like, a lot of these politicians believe in science, except when it comes to rent control, except when it comes to the study of economics. So it's very frustrating. But as we see throughout the country, areas with rent control, the cost of housing explodes, which means, right, it's a good place to invest if you're investing for appreciation. So I would expect to put any sort of rent control legislation in these two counties. I would expect to put upward pressure on housing prices, which is good for us as investors, even if we're having to get screwed a little bit on our cash flow.
Yeah, and I think that's important for you to recognize and tell our listeners is, again, the law of unintended consequences. Maybe don't look at it as necessarily being a bad thing. Could affect your cash flow. Maybe it really boosts your appreciation. As I say in real estate, every market is a good market to invest. You just got to know which angle to tackle it by. So, it's great to have people like you on the front lines actually bringing awareness to these issues, trying to educate policymakers first and foremost. And you're definitely approaching it, it seems, from an educational, informative standpoint, not, berating and belittling these policymakers, because ultimately, they're trying to do something that they think is best, and they're probably trying to solve a problem. They're just seeing it from a different angle. But, it's good to have voices out there in the public sphere, at least trying to educate and inform.
And it's important that we as investors and as realtors are really in this fight, because it actually makes a difference. So I always like to point back to Massachusetts rolled back rent control statewide, I believe in 1992 or 1994, right around that time, right? So these things can be undone. So it's important that we stay on the front lines and we fight these fights. And it's important that it comes from people of all walks of life, right? So no one feels bad for the person who owns a 100-unit apartment building, but they do feel bad for grandma who owns 2 rental properties that fund her retirement. And that's who most housing providers actually are. They're just small people who own 1, 2, 3 properties. I think that's like 70% of landlords in America.
I was just looking that up today. I was just looking that up today to see how many, and it's majority of landlords own 2 or less properties. So, man, great information, great information. And I think this is a perfect segue into our next segment of the show that James and I like to call the Big Four. James, take it away.
All right, Russell. So I want you to tell our listeners something that you do that is a financial independence cheat code, something that's like a personal hack that really propels your financial situation forward.
So I pay my mortgage, half of my mortgage on the 1st of the month and half of my mortgage on the 15th of the month. I do this on my personal property. And so what that does is, by paying twice a month, or sorry, not the 1st and 15th, every 2 weeks rather. By paying every 2 weeks, we get a full mortgage payment in every year that's extra. And what that works out to over the course of time is it'll take roughly 5 years off your mortgage on your back end, or most people aren't living there for 30 years. So it's going to just create a lot more equity than you would otherwise. Most people, I don't get paid every 2 weeks, but my wife does. Most people get paid every 2 weeks. So again, pay half your mortgage every 2 weeks. You get a whole mortgage payment in, save 5 years on your mortgage.
That's a great hack. Great hack. First time on the show too. What a great one. I love that strategy. All right, so this next one we call resources. So, are there any particular books, podcasts, or people that have shaped your investing or financial independence journey that you feel our listeners out there could benefit from?
Yeah, so I think everyone should have in their social circles, not only for this reason, but really, it really does help. When you have, I have a tax professional. You guys have interviewed her, Natalie Colletti. She's one of my best friends. When you have different people in your social circles with these expertise, you just learn so much from them, from just random, normal conversations. I know more about taxes than most everyday lay people because of my friendship with Natalie. So make friends with professionals. It could be a CPA, right? It could be a lawyer, it could be a realtor, it could be a mortgage lender, could be a retirement planner, but just have these people in your social circle because you're going to learn more from them, and then not have to pay them $300 an hour, their billable rate. You'll learn for free.
So true. So true. That's why James and I started this podcast so I could get free legal advice. And the last year and a half, it's paid off. It's paid off handsomely.
Yeah, we've done a couple purchase agreements and a couple conversations, so it pays off. Dividends, paying dividends, Patrick. For this next one, Russell, this one's your future you. I want you to paint a world 5 years in the future for Russell. What does it look like for Russell's personal life, for his business life? What's going on?
Yeah, so what does my life look like in 5 years? So I will have probably moved up in Realtor Association leadership in 5 years. So I'm my GCAR treasurer, so I might be the president by then. And really, I think my business won't look terribly different. Maybe I'll be making more money. But my business hasn't functionally changed much in the last 3 or 4 years. It's just kind of on autopilot at this point. More travel. So I am trying to take 6 trips per year right now. Maybe that gets increased. We'll see.
Hey, sounds like an awesome time. Sounds like an awesome time. All right. So for all of our listeners out there that just love the podcast, felt inspired, want to get in touch with you, want to reach out, where's the best way for them to get in contact with you?
Yeah, so very easy to catch me on Instagram. I answer almost everyone that DMs me. My Instagram handle's at Russell T Brazil. Additionally, if you want to learn anything about me, go to my website, districtinvest.com. We have the podcast, local one, the DC Real Estate Podcast. We're in the studio here, as you can see. That's on Spotify, iTunes, everywhere. And yeah, reach Facebook. I'm on Facebook, but Instagram is definitely the easiest place to get me.
Love it. Love it. All right. You guys know the drill. This podcast is free, but it's not. All we require is for you to give us a subscribe, give us a follow, comment on this post right here. Just do something. Leave us a review. That's what we appreciate so much. And we'll catch you next time. Peace.
See you guys.